Hey, welcome everybody to the 40 Finance channel. Today we're going to be talking about Amazon stock, looking ahead for Amazon into the back half of 2023, maybe even the start of 2024. Just like so many other NASDAQ stocks, this is one that started kind of an epic demise back in November of 2021, and then of course 2022 wasn't good for many stocks either. And there's a lot of questions out there with Amazon in terms of growth rate, in terms of expenses, and whether or not they can return to the glory days when they were growing at a rapid clip, or can they produce an EPS that makes them more or less a value stock, so to speak. Quick shout out as we go along here, SeekingAlpha Premium. This is the stock research platform I use all the time on my channel. If you're interested in learning more about SeekingAlpha Premium, my affiliate link is in the description. Get you a phenomenal deal, $99 for 12 months of SeekingAlpha Premium, potentially support my channel as well. So check out that affiliate link in the description. All right, let's kick things off with some of the momentum factors, the price action that we're seeing on Amazon over the past year or so. As I mentioned, it has not necessarily been a good stretch. And you see the one-year price performance is minus 35.83% versus the sector median of minus 9%. Then you stack that up against Amazon's 5-year average, where, on any 1-year cycle, they've averaged about a 23% return during that time. So definitely underperforming on a lot of perspectives. Now, if we look at price return versus the S&P over the past year, S&P is minus 6%. Year to date, where we've seen a lot of tech stocks come out and have a strong first part of the year, S&P's plus 5%, Amazon's plus 11%. So if you just started the year and you bought one S&P and one Amazon share, it would actually be Amazon that is overperforming, despite what I think is some very strong bearish commentary that's been out there about Amazon. All right, taking a look at moving averages. If you're waiting for the 200-day on Amazon, that's at 109.06 as of today, and you are 14% under that number. If you're talking about 100-day, you need to get up to 96.59. They are just below that, minus 3%. So investors who are waiting for those technical indicators, maybe to cross back over into a positive momentum swing, still a little ways to go there. All right, let's talk about the fundamentals today and looking ahead using forward projections, try to get a feel for how is Amazon valued today versus other points in its history. And SeekingAlpha has this great table that I use all the time. I always call out if you see this letter grade D or F for some of these valuations, please note that it's relative to the sector. So for me anyway, I take these valuation grades with a big grain of salt, because you also have to think about growth rate, stuff like that. And if we kick things off with PE non-GAAP trailing 12 months, you can see Amazon has had a lot of problems on the EPS line. They do not have a non-GAAP PE looking backwards. However, looking forwards, if you take into account earnings estimates that are out there after their most recent earnings call, you're at 64.82 based on current estimates. And if you look at that compared to Amazon's 5-year average, it's significantly lower. Okay, minus 66%. Amazon 5-year average has been 195 on the forward non-GAAP PE. If we look ahead at some of the other forward metrics, enterprise value to sales forward 1.9 versus 5-year average of 3.33. If we go enterprise value to EBITDA 12.35, that's been as high, or the 5-year average rather, as 23 in that category. And if we go down to price to sales looking forward, 1.72, that's minus 46% off of the 3.24 5-year average. And even cash flow, which is went backwards for Amazon here recently. If you take forward price to cash flow at 11.89 times, that is actually 48% lower than the 5-year average. So very interesting from a valuation standpoint, the forward metrics, which of course include estimates, so we have to keep that in mind, they are signaling that Amazon is relatively inexpensive, at least compared to the 5-year average. Now, the big thing that we have to worry about from there, of course, is the growth rates. All right, same table type view, but just looking at growth rates here. You have revenue growth forward plus 10%. That's the estimate for 2023. Now, in the past, Amazon has grown 22.39% on their 5-year historical average. So growth rate is down 54%. And remember that we saw valuation, was roughly half of what Amazon was getting in the past. So you can kind of see that correlation here. Then you go down to, how about EBITDA growth, 12.8%. Again, minus 50% off of the 5-year average. And then lastly, we talked a little bit about free cash flow. We can use operating cash flow looking ahead, 29%, right in line with the 5-year average. So ultimately here from a valuation perspective, if you keep in mind that the growth for Amazon is much lower than we've seen over the past 5 years, then it sort of makes sense that the valuation is much lower as well. The question, of course, for investors looking ahead through the end of 2023 and into next year is, can they beat their estimates, right? Can they beat estimates on growth? Can they beat estimates on valuation scores like EPS? That's what we're going to look into next. Okay, so it's been a month or so since Amazon's most recent earnings call. That's given us some time to let earnings estimates kind of adjust and see where analysts think things are going as of now. And if we go down to this year, looking ahead, December 2023, so this is fiscal period of 2023, the final for this will not get reported to the street until, approximately February of 2024. But if they hit consensus estimates at this point of $1.45 on the EPS line, that puts your forward PE at about 65, which is what we saw on the chart. Now, where things do get interesting as of today for long-term investors anyhow, is that projection for next year of 253, because that brings your forward PE down to 37. And as far as the 253 goes, we're a long way away from it on paper, but it's really just about a year. In fact, it's probably less than a year, because don't forget that the guidance for 2024 will come in at the same time that they report this. So if you're looking ahead from a valuation standpoint, the world's going to flip to this 253, assuming it stays on pace. The world will flip to that 253 right around February of next year. Then all of a sudden you kind of have this no-brainer forward PE, if you will, if they can keep their growth rates at least moving in the right direction. All right, now on the revenue side, this year, $557 billion is the current estimate, 8.51% growth. And we talked about how that growth rate has slowed. Obviously, with Amazon, most people are going to be expecting double-digit revenue increase. We'll have to see how that goes. But that puts your forward price to sales at 1.72, which is less than the 3x average or so over the past 5 years. But again, single-digit growth rate. So I think you have to trade 1 for 1 and just call this an even valuation. Now, similar to the EPS projections, 2024 we talked about is not as far away as it seems. You could start to resume that double digits, okay? 12.93% in 2024. And that to me feels pretty logical if you kind of make the assumption that some of these interest rates and recession fears and stuff by the time you get to next year should have come down. We'll see if that actually happens. But theoretically, I think we're in the declining stages of interest rate hikes. Whether or not they actually go down from here is obviously a whole nother debate. Now, if you're in the bull case for Amazon, you just got a little wind in your sails with this support from Goldman Sachs analysts. They call it now solidly a top pick. And the focus, one of the things that I thought was interesting here, the focus was really on AWS. And that to me makes a lot of sense because we know that AWS is wildly profitable and it probably has the most short-term prospects for doing something big on the revenue line, right? And Goldman Sachs goes to talk about, the current situation of IT spend versus what we've seen in the very recent past, 3 to 4 months, as huge corporations are trying to navigate these inflation and recession fears. They pulled back a lot of their budgets. They pulled back a lot of their commitments. Has that reached the bottom? And that's what Goldman Sachs is talking about in this article. So they say, a common thread across Amazon and Alphabet's cloud was a continuation of the theme of enterprise customers looking to optimize spend into an uncertain macro backdrop. So translation, optimize spend basically means cutting off as much fat as possible, which obviously would have affected cloud integrations across, dozens of other IT spending opportunities. Goes on to say, in particular to Amazon, any visibility into a bottoming of AWS growth would likely be a key catalyst for the shares. So this is in reference to what we've seen over the past few quarters where AWS growth rate has slowed compared to what it's done in the past. So bottoming doesn't mean really negative for AWS. It just means significantly slowing growth. So with that, from Goldman Sachs' perspective, increased industry conversations in the past few weeks point to signs that the optimization theme, in terms of spending, may have peaked around 2023 economic concerns in budget planning in late 2022. So this is kind of a convoluted way to write what I think this person's trying to say, which is, the peak of economic concerns and spend optimizations for things like cloud services peaked at the end of last year. And now companies are starting to open their interest level more into what they might be able to accomplish with additional cloud spending. And one of the things that I think has helped get over the fear of spending into cloud services has certainly been the press that we've gotten on the AI and the ChatGPT and all the things that are going on in that space. Obviously, if you're going to pull off computing at that scale as an individual corporation, it makes sense to offload a ton of that to the cloud wherever possible. So I think that this recent press frenzy of AI and chatbots and whatnot is a good thing for AWS as they continue to sell contracts in 2023. And then going a step deeper here in terms of AWS achievements, these were some of the bullet points from the investor letter that came out. This is new commitments and migrations from AWS customers. You have NASDAQ, you have NFL and AWS working on a contact detection challenge. You have Yahoo AdTech, who selected AWS. Stability AI selected AWS. Descartes Labs, if I'm saying that correctly, is going all in on AWS. Brookfield Asset Management selected AWS. Duke Energy. Then you've got Wallbox and American Family Insurance. We also had some international news. They launched AWS regions in Spain and Switzerland, as well as a second region in India to continue expanding AWS's infrastructure footprint. So there's more building and contracts going on. Not to say that this is enough to keep growing at a 20% clip, but it's encouraging signs, at least here early in 2023. All right, next up, let's look at some of the headlines surrounding costs. This is a big concern for Amazon from the bears. They had huge capital outlays during the pandemic in 2021 specifically. And so there's a lot of people calling for them to pull back on expenses. And obviously, it probably doesn't make a ton of sense to do that on the AWS side, right? So you have to start looking at the retail and e-com side as places that you could potentially save money. And here you can see they're shuttering some of the Go convenience stores, and they recently announced their headquarters, their second headquarters, is going to be paused as well. On the layoff side, Amazon laid off over 18,000 employees. This came earlier in the year, January 4th. And on a side note with this, the bulk of the roles due for elimination are concentrated in Amazon stores and PXT organizations per the statement. We saw the headline a second ago with the Go convenience stores. You have other grocery stores and fresh markets and things. So at least right now, this seems limited to just like brick and mortar type experiments. And obviously that does not play a huge role on the bottom line for Amazon because it's still in an experimental phase. All right, on the Wall Street side, over the past 90 days, you've got 32 strong buys, 17 buys, 3 holds, and 1 sell on Amazon. Again, this is from Wall Street analysts over the past 90 days, so some of those could have expired given the most recent earnings report. But what's interesting is you only have 1 sell, right? It's overwhelmingly positive on Amazon right now, at least from street analysts. As far as my take, I would say that Amazon stock right now at 90 some odd dollars, 92 or 3, I can't remember what it was. It's probably fairly valued given the growth rate that they're looking at in 2023. And with that in mind, I'd say you probably have time if you're looking to build a position in Amazon. I don't see this as a stock that's going to go up plus 50% or some crazy number like that this year. However, there are some good things brewing, and I'd go on the record and say the worst is over for Amazon in terms of outrageous expenses and slowing growth rate. Now, it's hard to project what's going to happen with this economy, and a consumer type recession or pullback would certainly hurt the retail side of the company, which would also hurt sales because that's when a big piece of the revenue comes from. But if you're looking at it from an AWS perspective and how much bottom line that business projects for Amazon, I would say the AWS bad news has got to be close to a bottom. And I think the way things are going here in 2023 with AI and the like, the use case for more cloud needs is right on the horizon. And depending on how things go with AI and how that connects to AWS solutions, you could be looking at the next bump in AWS adoption over the next 2 to 3 years. I would not expect to make $1 bazillion on it in 2023, but it's not a bad entry point for those of you who have a 3 to 5 year horizon. You may be coming off of a rare opportunity where Amazon's been beaten down hard for good reason. Let's just be honest about it. It's been beaten down for good reason, but if you see the future over the next 3 to 5 years, doesn't look so bad. All right, guys, before you go, don't forget to check out that special offer for Seeking Alpha Premium in the description. Hope everybody's doing well. We'll see you on the next video.